We are going to use two videos to discuss question 21 of chapter 3. In this video, let's have a look at this question, and then in the next video, we are going to talk about the solutions. Alright, so here's the question. Chapman Company obtained 100% of Apple Company's stock on January the 1st, 2017. As of that date, Apple has the following trial balance. So now we know Chapman Company is the parent company and Apple Company is the subsidiary company. And because parent company obtained 100% of the subsidiary company, then which means that it has 100% control of the subsidiary company. All right, so next we have the all the trial balance account of the subsidiary company, like accounts payable, receivables. Okay. And then during 2017, Apple reported net income of 80,000, while declaring and paid dividend of 10,000. During 2018, Apple reported net income of 110,000, while declared and paid dividends of 30,000. Okay, so we are given the income and dividend information for 2 periods. It's because this question we need to prepare consolidation entries for these 2 years. Alright, so the question is, assume that Chapman Company acquired Apple's common stock by paying 520,000 in cash. So this is the total consideration transferred from the parent company to the subsidiary company, and this is the also this is fair value of the consideration transferred. All of Apple's accounts are estimated to have a fair value approximately equal to present value. Chapman used partial equity method to account for its investment. Prepared consolidated entries for December 31st, 2017 and December 31st, 2018. Okay, so there are 2 important information in the last paragraph. The first one is Chapman, or the parent company, is using equity method. Okay, so that's going to impact how they update their investment account. And the second information is that all of Apple's accounts are estimated to have fair value approximately equal to its present value, which means that we do not need to make, there's no account have a different fair value than book value. Well, kind of make the calculation a little bit more easier than the 2 questions we did before, that is question 19 and 20. All right, so I'm going to use next video to show you the solutions. All right, to solve this question, step 1 is to prepare the schedule on how to allocate the acquisition date subsidiary fair value. So in that schedule, the first thing to calculate is the consideration paid. So the considerations paid by the parent company is 520,000 cash. And the second is to calculate what is the total book value acquired by the parent company, or what is the book value of the subsidiary company. Book value. So the book value of the subsidiary company can be calculated by 2 methods. One is to use its total assets minus its total liabilities, and the other method to calculate the total of its equity accounts. So we can use the second method, and the total amount of its equity equals to 50,000, the additional paid in capital, plus 250 common stock, and plus 100,000 return earnings. So the total is 400,000. And then next we can calculate what is the excess of considerations over book value. So the excess amount equals to the difference between 520,000 and 400,000. It equals to 120,000. And then the next step is to allocate this excess amount to those accounts with different fair value than book value. However, in this question, all of Epson's accounts are estimated to have a fair value equal to the present book value. Okay, so allocation. Which means that we do not have any account that is needed to be put here. And if that's the case, then it means all of those excess amount will be allocated to goodwill, because this is a positive number. If it's a negative number, then that goes to the gain. Okay, so total goodwill will be 120,000. And also because all the accounts have the same fair value as its book value, which means that we do not prepare that additional schedule, the excess annual amortization. Okay, and then I'm going to use next video to show you the consolidation entries. First, let's prepare the consolidation worksheet entries for Chapman, the parent company, at the end of 2017. The parent company is using partial equity method, and the consolidated entries it need to prepare is very similar to equity method. There are 5 entries they have to prepare at the end of the first year. That is S, A, I, D, E. Okay, and then let's prepare them one by one. The first entry is entry S, so that's for 2017. Entry S. So the purpose of consolidation entry S is to eliminate the subsidiary company's equity account balance. And currently, the subsidiary company Epson has 3 equity accounts. That is common stock, additional paid-in capital, and beginning return earnings. And each of them has a positive credit balance, so which means that we need to debit them. So we debit common stock 250,000, 50,000 for additional paid-in capital, and 100,000 for retained earnings. And then we credit investment in Epson. In total, that is 400,000. Okay, so this is entry S. Entry S, we use entry S to eliminate the 3 equity account from the subsidiary company's book. The next one is entry A. So normally we use entry A to adjust the subsidiary account that has different value from book value. But in this case, because all the Epson's accounts are estimated to have the same fair value to book value, and we only have one accounting to prepare here, that is goodwill. We'll debit goodwill and credit investment in Epson. Dollar amount is 120,000. Okay, so next entry is entry, let's say entry I. And entry I, we use entry I to eliminate the investment income from the parent company's book. because this is the inter-entity transaction. So we debit income from Epsilon and credit investment in Epsilon. In total, it is 80,000. With partial equity method, the investment account amount is going to be the reported income from Epsilon without any adjustment. Okay, next one is entry D. So we use entry D to eliminate the dividend paid from Epsilon to Chapman. Okay, so we debit. So here now we debit investment in Epsilon and credit dividend from Epsilon, 10,000. Alright, so the next entry will be entry E. If there's any excess annual amortization, but in this case, because of the Epsilon's account have fair value equal to present book value, so we don't have any excess annual amortizations, then which means that we do not need to prepare entry E. Okay, so I'm going to use the next video to prepare consolidated entries for the second year or 2018. Alright, in this video, let's prepare the consolidation entries for 2018. This is the second period. If a company is not using equity method and using the other two methods like partial equity method or initial value method to adjust its investment account, then normally the first entry they need to prepare is the entry star C. And then following star C, we're going to have the same other consolidation entries like S, A, I, D, and E. But we know that for this case, we do not need to prepare entry E. Well, also for this case, we do not need to prepare entry C as well. The reason is that entry C, the difference between equity method and partial equity methods is related to that annual excess amortization expense. But in this case, because that annual excess amortization expense is 0, which means that the adjustment for star C is not necessary. Okay, so then let's start with entry S. Entry S. So entry S is to eliminate the subsidiary's equity account balance at the end of 2018, and we're going to still have the same 3 accounts to take care of. The first one is common stock. Its balance is 250,000. Second account is additional paid-in capital. Its balance is 50,000. Both of them are not changing since they are not issuing any new stocks. And last one is beginning balance of retained earnings at 2018 of Epsilon. Well, remember, this is the beginning balance of the second year. After 1 year operation, the retained earnings of Epsilon will be different from the first year. Okay, and now let's see what's going to be the balance for this retained earnings. So retained earnings at the beginning of 2018 would equal to the retained earnings at the end of 2017. Well, then it should equal to the beginning balance of retained earnings in 2017, that is 100,000, and plus 2017's reported net income of Epsilon, which is 80,000, and minus dividend paid by Epsilon in 2017 is 10,000. So this is the basic equation on how to calculate the balance for retained earnings. Okay, so it equals to 170,000. That's 170,000. And then we need to credit investment account. Investment. Absolutely. Okay, so the investment absolutely credit amount will be the total of the debit balance. That's 470,000. Okay, so that's entry S. Next one is entry A. So entry A is going to be the same in the second year because we do not amortize goodwill, and also assume there's no impairment of goodwill, so we debit goodwill 120,000 and credit investment in absolutely 120,000. So this is the entry A, and then entry I to eliminate 2018's intra-entity income. So debit income from absolutely. In 2018, the reported net income is 110,000, and credit investment in absolutely 110,000. And the next entry is entry D to eliminate the dividend paid from absolutely to Chapman. So we debit investment in absolutely and credit dividend from absolutely. The amount is 30,000. We do not need to prepare entry E because there's no excess annual amortization. Alright, so that's all the entries we need for the second period, or for 28.